Hello everyone, and welcome back to the Quant Lab. In Chapter 1, we discussed the underlying mechanics of the exchange, specifically how the opening and closing prices are calculated via the call auction. Because these auctions aggregate massive amounts of institutional capital, we established a golden rule. The opening price represents the market's initial expectation, and the closing price represents its final commitment. Today, we are going to apply these intraday mechanics to validate the structural boundaries we built earlier in this chapter. We must establish rigid mathematical rules to differentiate between intraday algorithmic noise and true macroeconomic breakouts. Retail traders constantly get trapped buying a stock the exact second it crosses above a resistance line, only to watch it crash an hour later. This happens because intraday penetrations, the upper wicks of a candlestick, are statistically meaningless. High-frequency algorithms constantly spike the price above resistance specifically to hunt retail stop losses. To quantitatively validate a breakout of a dense trading zone, we rely strictly on the closing price. Let's look at this diagram. We have an overhead resistance zone bounded between 200 and $10. Day 1, the price rallies and closes that center at $205. Because it closed inside the zone, this is an internal rejection. The overhead supply is fully intact. Day 2, the stock violently spikes to 125 intraday. A retail trader might see this green spike and buy the breakout. But look at the close. Algorithms harvest that liquidity and smash the price back down to close at 195. This is an invalid breakout, pure noise. Day 3. The asset surges again, but this time the final closing bell rings with the price at $215. A true structural breakout is only confirmed because the daily candlestick definitively closed above the upper to $10 boundary. The overhead supply is mathematically exhausted, and by the principle of polarity, this 200 to 210 ceiling instantly flips to become our new support floor. Okay, what happens when the 4 p.m. closing bell rings? The market enters the overnight session. Institutional block orders stop executing and liquidity dries up entirely. If major macroeconomic news like a geopolitical event or an earnings report is released during this overnight vacuum, the underlying valuation of the asset fundamentally changes. When the morning call auction opens at 9:30, the price executes a massive gap. And if you are not careful, this gap can violently invalidate a seemingly perfect structural breakout. Let's look at a real-world case study on the daily chart of a defense sector asset. Similar to Lockheed Martin in early January 2026. Look at the 498 to 512 region. This is a historical established support zone. On January 7th, due to negative sentiment, the price broke strict through the $498 floor and closed aggressively lower. Based on our closing validation rule, this was a confirmed breakdown. The math signaled a massive short sale opportunity. But overnight, highly positive macro news was released. Market sentiment completely inverted. Look at the open on January 8th. The stock executes a massive gap up, opening back inside the broken support zone. The single opening print mathematically nullified the previous day's breakdown. Any short seller who blindly trusted the previous day's close without dynamically adjusting for the opening gap was instantly trapped in a massive loss. While the close validates the structure, the open dictates your immediate execution bias. How do we treat these gaps? By waiting for the retest. If an asset gaps up completely above a major resistance zone, institutional conviction is highly bullish. Do not buy the opening spike. Let the amateur chase it. You wait for the intraday price to pull back. Retest the top of the broken zone, which is now support, and you execute your long position on the bounce. Conversely, if an asset gaps down entirely below a major support floor, the structure is broken. You wait for the price to rebound. Retest the underside of the broken zone, which is now resistance, and you execute your short sell upon rejection. In our next session, we will add another dimension to our structural analysis, volume and the anatomy of the candlestick. See you in the quant lab.